Gap up, gap up and gap down candlestick pattern. This pattern is widely applicable for daily time frame where you can see this pattern very frequently in the daily time frame. This is a bullish candle and this is the high of the candle, this is the low of the candle. So next day when the candle opens or the market starts, it has to start above the high of previous day's candle, leaving some gap like this. Okay, this is the low of next day's candle. So this gap is called gap up. Likewise, in gap down also, this is a bearish candle. This is the low of the candle. Next day, when the candle opens and closes, the high and the low, in between there is a gap. This gap is called gap down. The gap up and gap down patterns occur when a security opens significantly higher or lower than the previous day's close without any trading in between. This is the same thing I have explained here. There is a significant gap between previous day's candle high and the today's candle low. This we can call as gap up and gap down. A gap up suggests a strong buying interest while a gap down indicates heavy selling pressure. Yes, when there is a gap up, technically it is like there is so much of demand for that stock or index so that it happened some gap up and open here. Likewise, if there is any bad news like any war related things, any bad news related to the stock market, then eventually the market opens little bit gap down like this. These gaps can act as continuation signals if the trend follows through, or reversal signals if the price fails to sustain the direction of the gap. So we can expect a bearish trend after the gap down until it uh, until it covers the gap, we can expect a bearish gap, bearish trend in the index or the stock when gap down happens. There are a few types of gaps, that is like a breakaway gap that happens at the beginning of a new trend, a runaway gap occurs during an existing trend, and an exhaustion gap appears near the end of the trend. The type of gap provides insight into the potential future price movement. So, we have discussed about three types of gaps: breakaway gap, runaway gap, or exhaustion gap. Remember this. I will give you example regarding these gaps because this is a very frequently occurring candlestick pattern in the daily time frame. You can understand this and implement in the live market. So, this we can call, this is the candle, previous day's candles low and today's candles high. So when this candle opens and closes, this is going to be a gap. From here till here, this is going to be a gap. So let's see three types of gaps here. This is a daily chart. Okay. See, this is the low of the candle. This is the high of the candle. There is a significant gap between previous day's candles close and today's candles high. So we call it as gap down. We even call it as breakaway gap. Okay. So again, what is the another gap? Runaway gap. That means when this happens, we can expect there is going to be a slightly fall from here, and the next gap happened here. You can see big gap happened here. We can call it as a runaway gap where we can expect some more fall in the market. So, and there is an extended period of downtrend, and again, if there is a gap up, gap down opens, we call it as sometimes exhaustion gap, and we cannot say whether this gap is going to be a exhaustion gap or this could be a exhaustion gap. Why? Because we never know until the candle or the days pass on whether it is the end of the trend or not. But there is a significant trend before this gap. So we can expect the market to move in opposite direction. Sometimes it may fall even down and then take some take against the trend. So you can see here it took support here. It took support somewhere here. There is a big gap up here. So this is the previous day's high and this is the candle's low. There is a gap between these two candles. So we can expect some good move from here till here. So key tips for the gap up and gap down candlestick pattern. A gap up occurs when the opening price is significantly higher than the previous close. Here, close is very important. And a gap down occurs when the opening price is significantly lower than the previous close. Gaps can signal strong momentum in the market. Okay, works best when supported by volume and follow through price action. If a gap filled it weakens the pattern strength. So how this candlestick pattern is constructed? The first candle, the last trading session's close price, and the gap formation, a noticeable price gap on the opening of the next session, which I have explained here. Second candle, the price action that follows the gap, confirming or rejecting the move. So what we can forecast with this is sustained gap suggests a continuation while a filled gap may signal a reversal. What is the type of the pattern? It's a single day momentum pattern. Trend prior to the pattern, it can occur in any trend, but it is more significant after a strong move. So where we have to place the stop loss, this is very important. Below the gap for a gap up or above the gap for a gap down. So how to set a trade with the gap up and gap down candlestick pattern. Identify a significant gap at market open. Okay. Determine if the gap is a breakaway play, runaway play, or exhaustion gap. The meaning for this is when it is the first time gap, we can call it as breakaway gap. When it happens multiple times, we can call it as runaway gap. After an extended period of trend, we call it as exhaustion gap. And enter a trade in the gap's direction if momentum continues. You have to place the stop loss below the gap or above the gap depending upon the trend. Set your target profit based on next support and resistance levels.